welcome to Virtual Investor Conferences. On behalf of OTC Markets, we're very pleased you joined us for the Small Cap Growth Conference. Our next presentation is from Ethema Health. Please note you may submit questions for the presenter in the box to the left of the slides, and you can view a company's availability for one-on-one meetings by clicking Book a Meeting in the top toolbar. At this point, I'm very pleased to welcome Sean Leone. He's the Chief Executive Officer of Ethema Health Corporation, which trades on the OTCID market under the symbol GRST. Welcome, Sean.
Thank you, John. Nice to be here. Hi, everyone. Just want to summarize what we're going to talk about today. We're in the addiction treatment space. We run inpatient addiction treatment centers and currently operating in Kentucky and Florida. We are looking to raise some new equity for the company with some significant opportunities for expansion. So that's what I want to talk to everyone about today. So the typical disclaimer, which is here on the screen, and we put up on all these presentations. So just as an executive summary, we currently have approximately 400 beds in Kentucky and Florida. We have approximately 325 current clients in our census today. We expect to grow to 3,000 beds throughout the U.S., mostly in the eastern half of the country in the next 2 years. A couple of years back, we were talking about growing to 500 beds when we had like 30 beds. So, we do expect to make it to that level. We do have a large number of beds under LOI currently. That's the opportunity we have in front of us in Kentucky. One of the main reasons for raising cash. We are profitable and we're cash flow positive, so we don't need money for the company per se as is. We just are looking to expand and grow the company, and we need cash to do that. We have an experienced management team, and we have unique sets of treatment modalities that we've developed over the last 14 years of being in this business. Just to let you know that, say, a typical valuation for a bed might be $200,000 given the mix of beds that we have. So we have, potential to get to a $600 million valuation if we get to the 3,000 bed target that we're aiming to get to in the next 2 years. And of course, one of the things we need to do is to get off the OTCID market and onto a senior exchange, because where we're at company-wise and where we at with the types of funding that we need to raise is not suitable for the OTCID market. And of course, we need to get up to a senior exchange. The market overview in general for addiction treatment is very robust and favorable. A lot of factors that contribute to that. Back in 2008 with the Mental Health Parity Act, addiction treatment became a mainstay of healthcare benefits. So we have a large built-in network of payers for addiction treatment. There are a large number of treatment centers in the U.S., just ballpark around 17,000. But the environment with the payers at all levels of pay and where we're sitting today is very favorable for us in the coming market. Everyone knows the story of mental health and addiction and the demands that are out there. Usually don't have to remind people too much about this part of the presentation because everyone knows the need is huge, the market is huge, and we're intending to provide care in this market. One of the other things that's always been on the forefront of people's minds is, the new modalities for treatment, such as, plant-based derivatives, psychedelics, that type of thing. We're keenly aware of all those types of treatments, but until they're actually legal and or supported by state licensing agencies and accreditation agencies and the insurance companies, is not something that we can get into. But we're certainly keeping our eyes on that market, and we'll always want to get there if at all possible when and if that happens. Very small board at the moment, very flexible company based on the fact that we're going to be growing significantly. Myself and Jerry Miller, third director that we had, passed away recently. We are looking to expand our board, but you'll hear in a little bit about our plans and how to grow the company to a senior exchange, and that might be more of an appropriate time for us to expand that board. This is a small history of our growth. From 2011, we opened our first treatment center in Canada, 41-bed facility. We sold that in 2017. We moved into the Florida market in 2018. Had various different treatment centers in the Florida market, but finally settled on the one that we have currently in West Palm Beach in 2020, just right around when COVID hit. And from that point on, from 2020 till today, we've grown from really a standing start of no beds to where we are today, which has been pretty good growth path. And we intend to keep growing it. So you can see we have a deep history in this business, and we intend to keep going. It's a pretty simple structure today. The public company, Ethema Health Corp, as we said, is listed on the OTCID. There's a large number of shares outstanding, 7.7 billion, but it's trading at fractions of a penny. So currently a very small market cap of around 3 to 4 million. We have three divisions. One is our billing company. The second is our Florida addiction treatment company. It has two locations in Florida, West Palm Beach and Boca Raton. And then we have our Kentucky addiction treatment company, which has multiple locations, located in two different cities, in Paducah, Western Kentucky, and Moorhead in Eastern Kentucky. And currently the expansion opportunity for us is in Kentucky. So that's where we want to grow the company in the next short while. As you can see, we have in 2023, so these numbers are representative of what's in the company today, but they weren't always in our company. So if we look at where we are in this third column here, 12 months ending December 31st, 2025, we should come in at around 21.5 million in revenue. That's 8.5 million in Florida and 13 million in Kentucky. EBITDA numbers on that, about 2.5 million. That same number of beds without any growth factor will increase to about 25.8 million in 2026, with 5.7 million of EBITDA. We have all sorts of other growth plans. So 2026 is only representative. This number that I'm quoting here is only representative of what's in the company today, and without adding any more beds or any other locations. But there has been a history of earnings in these existing beds. The Kentucky operation we took over from another operator, so it's not new. It's been there. So these revenues have existed in previous periods, which is important when we're looking at financing. People want to see a history of earnings and revenue, and so we certainly qualify in that area. But we do think that the potential to grow, given what we're looking at bringing into the company, could take this easily up over 100 million of revenue, even in 2026. So some pretty exciting stuff on the horizon. We have a formula that we've developed. Companies in this industry have traded 10, 12, 15 times EBITDA in the past 5 to 10 years. Currently, things trade at lower margins, lower multiples, I should say. We are getting good reception when we talk to people about paying 6 times their EBITDA. The current opportunity in front of us, we've structured it such that we would pay 1.5 times EBITDA in cash, issue a note to the seller for 1.5 times EBITDA, and have the seller convert equity for 3 times the amount that we're paying. So it's a very easy formula for us to finance. Cash flow lenders will lend us, up to 3 times EBITDA. So to be able to borrow 1.5, it's pretty easy. So we could literally finance this without raising any new equity. However, we do plan to raise some new equity. So this is a little about what we currently have in the company. Here's the existing column here. The very first column is around 420 beds between Florida and Kentucky. We can acquire through the current LOIs around another 536 beds, including some psych beds in Kentucky. And by expanding the real estate and facilities associated with these acquisitions, we can grow the company by about another 464 beds in identified existing facilities that are related to these acquired beds. So we could get to 1,420 beds literally this year in 2026, this coming year, I should say. The cost to get us there would be approximately 30. I think we have a typo here. I think that should be $68 million. But you can see that the cash required would be very small, in the range of $13 million. And that $13 million of cash would get us a projected EBITDA of about $25 million. So with very little cash, we can grow the company substantially and build an EBITDA of substantial EBITDA of 25 million. And if that was, even if it was trading at 6 times EBITDA, that would be a $150 million company. So to go from a $3 million company to a $150 million company is it's there, it's laid out in front of us, it's available to us, and it's something that we think we can easily achieve. The first 3 acquisitions have some ancillary services as part of the group of companies that are available to us. There's a pharmacy, a lab, and a rural health clinic, which is like an outpatient clinic. So these are not traditionally what's in the company now. We have only inpatient addiction treatment beds with a little bit of outpatient. So these ancillary services would service the existing facilities and the newly acquired facilities, so they could potentially be another added source of revenue for us and an added source of income. So we're targeting those as the first things to bring into the company, and expect to try and get these closed in the next very short period of time. So with the 10 million that we raise, if we raise that cash, we would use that to acquire the pharmacy, the rural health clinic, and the lab. You have another $1 million of working capital. I should say that all the growth through acquisition that we're talking about, it is dependent on us raising money. If we're unsuccessful in raising money, then our expansion won't be as quick and fast. However, the amount of money that we need to raise for the type of growth that we can get it's minimal compared to what we're buying and we're growing to. So we think that we should be able to raise this money pretty easily, but nowadays that's not easier said than done, I guess. So one of the things we did in Florida, because our industry is real estate intensive, and we have a lot of real estate associated with any facility that we run. One of the things that's available to us, and we definitely have made a decision in our company not to own real estate in the company. We went down that path in prior years. It ended up getting us in a little bit of trouble back in 2017 through 19. Failed to close on a piece of real estate, lost some money based on that, and you know that led to the actual large number of shares that we have outstanding today. But a sale leaseback is where you take one of your facilities that you might own or you might be able to acquire and sell it to a fund who will then lease it back to you. So it's a way of financing the real estate that you're going to be in on a long-term basis, giving you security of the facility. There's a bunch of facilities involved in the LOI and the acquisitions that we're looking at. There's a group of 6 different buildings with various different values, but the amount that we could take out of that group of buildings, you can see here in the third last column, the leaseback proposed sale amount. We could take 88 million out of those buildings, and they would only cost us 46 million. So we could generate a cash of 42 million just on the real estate side of this, which we could put towards, you know, the acquisition costs of acquiring those beds. So it's a non-dilutive off-balance sheet way of acquiring operations for the company. It secures the real estate long-term for the company. It gives you, good solid future for the facilities without having to tie up capital. In fact, it does the opposite. It frees up capital for you to deploy in picking up these operations. So we think that we'll be using this as a part of our, expansion strategy. And we're actively engaged with sale leaseback funds looking at real estate now. So again, the message is that we can acquire a large amount of revenue and income with very little dilutive financing. With as little as 10 million of new equity, we could grow the company 6 to 7 times where it is today. So we think that the strategy for us to grow this is sound and doable, and we're pretty excited about the possibilities for what's coming up. We have to probably restructure. This is sort of the big question for us right now. The current company, Ethema Healthcare, which is you can see up here in the top left-hand corner, we're looking at potentially creating a new subsidiary of this company, moving our existing Florida and Kentucky operations under that subsidiary, and having that subsidiary IPO as opposed to uplisting our existing company. We haven't firmly decided this strategy yet, but we're close to deciding, and whether we uplist Ethema or we create a new subsidiary that does a direct IPO on a senior exchange, and or another strategy is to merge that company with a currently listed at NASDAQ or NYSE listed company. There are several of those that we've looked at, but one way or another, we need to get this onto a senior exchange. If we do it this way, then the new shareholders of new equity we raised would be invested in that new subsidiary. The person that owns the current group of companies that we're looking to acquire would become a shareholder in that company. And you can see below that line, the dark blue are the 2 companies we currently have existing. The light blue colored companies are the acquisitions that we would acquire that are non-related, so being pharmacy and a rural health clinic and lab. And then you can see that under the Kentucky operation, we would add these other light blue colored acquisitions. And in the green box, we have the expansion. So this would be really the proposed structure of what this plan would all look like. And again, we think that that's very doable. So we can get to where we need to go this year, or I keep saying this year, but in 2026. So next steps: complete the reorganization, complete the financing, get the IPO done, get the uplisting done, and complete the acquisitions. It's got a lot of factors for success: growing market, recession-proof business, very experienced operator, fast growth, great valuation, and a very secure structure that we proposed. So I'm going to conclude it there, and I will take a look at some of these questions here. So there's a question: with a large Kentucky Medicaid book of business, how sensitive are revenues to rate changes and managed care carve-outs? Again, we are heavily exposed to Medicaid in Kentucky, and we are susceptible to changes to Medicaid, and pricing that the federal government will put or provide for addiction treatment care. I guess the one thing that I always answer this question with is that addiction it's a huge problem, and no one's going to ignore it. And whether the funding comes through the federal government, through Medicaid, or marketplace policies or traditional policies, one way or another, I think it's going to get provided for, because the problem is too big to ignore. So you can be susceptible, and what our plan is to expand into probably looking at Ohio, West Virginia, to be in multi-states, because different Medicaid and payment options happen differently in different states. And the idea is to always sort of be less exposed to any one state and any one insurance plan. So Florida is all in-network insurance. It's got nothing to do with Medicaid. Kentucky currently is 99.9% Medicaid, but we will start to branch out into commercial insurance there, and then branch into other states to help deal with a potential overexposure into one area. I guess another question here: can you walk through the milestones in 2026 to list on NYSE American? Really, the options are, we qualify more or less today. We have the requisite number of shareholders. One thing, obviously, for an uplist is that we would have to do a reverse consolidation to get our stock price to the required amount, or the required price to uplist. That's if we go the uplist route. If we do an IPO, obviously that issue would be not an issue, and or if we merge with an existing listed NYSE company, or NYSE American or a NASDAQ company, then again that issue would be not a challenge for us. So it's the milestones. There's not really any milestones. It's really just selecting and picking the one route that we're going to go and pursue, and doing what's required to get to the listings. Our reverse merger is pre-approved. It's already been approved by the shareholders. We just haven't done it yet until we actually need to do it for an uplisting. So all the steps, it's really just the administrative steps that you have to take to get to that goal of uplisting. I have another question here. For the 1,420 beds shown in the 2026 plan, how many are under binding purchase agreements versus non-binding LOIs, and what are the expected closing dates? So the answer is there's nothing binding. Everything is under LOI. LOIs, tend to be non-binding. Even purchase agreements tend to be non-binding until you actually close. So we can say that both sides are aggressively looking to do the deals, and closing dates are, as early as this month in December, and as late as, first quarter of next year. However, it really is all tied to financing and having that completing the financing. Our financing sources are many, and we're negotiating on that front as we speak, but nothing is firm yet. So the answer to that is that everything is non-binding at the moment, and we hope to be able to announce firm closing dates and or acquisition financing in the very near future, but at least by the end of the first quarter, we expect to see all of this transpire. There's a question here. What are your primary ways of trying to raise money? We've covered a little bit about that in the presentation, from equity to debt to sale leaseback transactions that would provide off-balance sheet financing, but the majority of the largest amount that we see as being most practical is debt and our sale leaseback transactions. Equity is just very expensive at the moment, being a smaller company. I'm not afraid of equity. We want to do equity, but we won't sell equity at valuations that are below what we think the company's worth. So those equity valuations will be, we have a pretty good idea of where that has to be, and it's way higher than the current market price. Fortunately, the market on the OTCID just doesn't get kind of attention it should, and doesn't trade where it should. That's why we're anxious to get uplisted to a senior exchange, and so that we can get more equity participation at a valuation that is reflective of what's in the company. Our trading history over the last 3 years is, we're trading at the same price we were when we had nothing in the company. We have 25 million of revenue in the company now. We have 2 to 3 million of EBITDA for this current year, probably 5 to 6 million for next year. In stuff that's already in the company, and to trade at a $3 million market, even though we do have some debt, there's significant value to the company today, and we hope to be able to prove that out over the next few quarters. But I think we've already proven it to a large extent. So that's where we want to go with that. I have some questions here on the ARC transaction itself and some of the things going on with that vendor, but those are questions that we refer back to the vendor. So we don't publicly comment on any of those questions. Long-term goal here is to just continue to grow the company to the 3,000 bed mark and get there within the next 2 years, where we will generate a significant market cap company. And I think it's one that's worth anyone's attention in terms of wanting to find very good value today to buy a stock that will appreciate over the next couple of years. And I think that's our story. I guess with that, I will terminate the questions and the answers. Thank you.